Right after Donald Trump won the 2024 presidential election, something interesting happened. Fresh data from December showed that many countries started pulling back on how much U.S. government debt they held. Out of 20 major economies that usually invest in U.S. Treasury bonds, 16 decided to cut back. Some of the biggest reductions came from the United Kingdom, which slashed its holdings by $44.1 billion, followed by Japan with a $27.3 billion drop, and Saudi Arabia cutting $15.1 billion. Other countries also trimmed their investments, though by smaller amounts. China reduced its holdings by $9.6 billion, Switzerland by $9.7 billion, and India by $14.9 billion. So, why the sudden shift? It seems that many global investors and central banks were feeling cautious. They were uncertain about what Trump's policies might mean for the economy and wanted to avoid any surprises. This isn't a new strategy. Countries that invest heavily in U.S. debt always keep a close watch on factors like trade policies, interest rates, and diplomatic moves. If they sense unpredictability or risk, they tend to pull back to minimize potential losses. One major concern is how much money the U.S. government plans to borrow. If investors believe upcoming policies could weaken the dollar or significantly increase national debt, they might see U.S. Treasuries as a riskier bet. When foreign investors start selling off these bonds in large amounts, it can drive up interest rates, making it more expensive for the U.S. government to borrow money. This doesn't just impact Washington. It can also hit everyday Americans. When foreign investors pull back from U.S. debt, it can lead to higher costs for families and businesses. That means pricier mortgage rates, more expensive business loans, and overall tighter financial conditions. But there's a bigger picture here. If this trend of selling off U.S. debt continues, it could shake confidence in the U.S. dollar as the world's go-to currency for trade and savings. For decades, the dollar has been the king of global finance. But when major countries start cutting their U.S. debt holdings, people start to take notice. If this keeps up, we could see a gradual shift toward other safe haven assets, things like euro-backed bonds, other major currencies, or even old-school gold. And this isn't just about numbers on a spreadsheet. The sell-off following Trump's 2024 election win could reflect deeper tensions beneath the surface. Trade disputes, diplomatic strains, and shifting global alliances all play a role. Big investors don't always make a big fuss about it, but when they start moving their money elsewhere, it sends a message. These changes don't happen overnight, and countries don't need to make public announcements to have an impact. But little by little, as they reduce their U.S. debt holdings, it can chip away at the dollar's global dominance. And if future policies bring more uncertainty or spark fresh conflicts, this trend could accelerate even further. What started as a post-election shakeup could turn into a long-term trend of countries spreading their investments beyond U.S. markets. Central banks have traditionally stocked up on U.S. Treasuries because they're seen as one of the safest financial assets, kind of like a global safety net. But lately, many countries are rethinking that strategy. Instead of putting all their eggs in one basket, they're diversifying their reserves by adding other currencies or assets, especially gold. This movement, often called de-dollarization, is all about reducing reliance on the U.S. dollar. Take China, for example. It has been quietly cutting back on its U.S. Treasury holdings, which dropped to $76.1 billion in October 2024, the lowest level since 2009. This is part of China's bigger strategy to reduce its exposure to the U.S. financial system. One major reason for this shift is the power the U.S. holds in global finance. The U.S. can use its influence to impose sanctions, and that has made some nations rethink their heavy dependence on dollar-backed assets. This isn't just speculation. According to the Unhedged podcast, central banks and sovereign wealth funds are snapping up gold as a hedge against potential U.S. sanctions. Countries like Poland, Turkey, India, Iran, and China have been leading this gold-buying spree. There's also a more tactical reason behind some of these sell-offs: currency control. Some nations sell off U.S. Treasuries to strengthen their own currencies. Japan, for instance, reduced its holdings from $1.087 trillion in November 2024 to $1.06 trillion in December, likely part of an effort to stabilize the yen. Japan's recent decision to reduce its holdings of US dollar assets wasn't just a random move. It was a calculated effort to boost its own currency, the yen. By selling off US Treasuries and buying more yen, Japan aimed to strengthen its currency and stabilize its economy. But there's a trade-off. When countries do this, they end up holding fewer US bonds in their reserves. Meanwhile, back in the US, Treasury yields have been climbing. Why? A mix of policy changes, like new tariffs and shifts in immigration rules under Trump's administration, has fueled expectations of stronger economic growth and possibly rising inflation. And when inflation rises, interest rates tend to follow, pushing up the yields on government bonds. But here's the catch. When yields go up, the value of older bonds, those issued at lower interest rates, drops. This forces investors to rethink their strategies, adding even more pressure to the market. On top of that, the Federal Reserve has signaled that it may slow down its plans to cut interest rates in 2025 due to inflation concerns, reinforcing the upward trend in yields. Stepping back, this is part of a bigger, long-term shift that has been unfolding for decades. Since the 9/11 attacks, the U.S. has increasingly used its financial system as a tool of influence, leveraging the dollar's global dominance to control access to its banking system and impose sanctions. This approach has given the U.S. significant power on the world stage, but it has also made some countries more determined to reduce their dependence on the dollar. The U.S. has long used its financial power to apply economic pressure on countries like Iran, North Korea, and Russia. But this strategy hasn't gone unnoticed. Nations on the receiving end of sanctions, and even some U.S. allies, have started asking an important question. Are we too dependent on the U.S. dollar? That question has fueled a growing global movement toward de-dollarization, reducing reliance on the greenback. One of the key ways countries are doing this is by trading directly in their local currencies. China and Russia, for example, have ramped up trade deals using yuan and rubles instead of dollars. India and Iran have explored similar setups, making it easier to bypass U.S.-controlled financial channels. Another major shift is the development of alternative banking systems to sidestep SWIFT, the global messaging network that most banks use but one that is heavily influenced by Western powers. In response, Russia created its own system, SPFS, while China rolled out CIPS for cross-border transactions. These systems give countries more control over their international payments and help them dodge potential U.S. sanctions. Global alliances have also joined the push. The BRICS group, Brazil, Russia, India, China, and South Africa, has been actively discussing the creation of a new reserve currency that could rival the dollar. Russia, in particular, has been pushing its trade partners to switch to alternative currencies, especially after facing waves of Western sanctions. Even the oil market, which has long been dominated by dollar-based deals, is starting to shift. Countries in the Gulf Cooperation Council, GCC, have begun considering accepting payments in other currencies, like the Japanese yen, a sign that global trade habits could be in for some big changes. Central banks aren't just watching from the sidelines. Many are shaking up their foreign exchange reserves, pulling back from US Treasuries and stocking up on gold, a classic safety net in uncertain times. China, Japan, and India have all been quietly adjusting their portfolios, cutting their U.S. bond holdings while boosting investments in other assets. Countries around the world have been quietly but deliberately taking steps to shield their economies from the ripple effects of U.S. monetary policies and economic pressure. This shift isn't about abandoning the dollar overnight. It's about creating more options and reducing over-reliance on a single currency that holds immense global power. The idea of the US dollar losing its status as the world's dominant currency might seem unlikely, at least for now. But little by little, nations are finding ways to gain more financial independence, whether it's trading in local currencies, stockpiling gold, or building alternative banking networks. The push for greater economic control is gaining momentum. This slow but steady shift depends on several factors: global politics, the strength of new financial systems, and how well countries can work together to sidestep dollar dominance. While the dollar still reigns supreme, cracks are beginning to show in its foundation. And this isn't the first time the world has seen a major currency shift. Before the US dollar took the top spot, it was the British pound sterling that dominated global finance. The pound's power was closely tied to the British Empire's vast network of colonies and trade routes, making it the go-to currency for international commerce throughout the late 19th and early 20th centuries. Britain's financial dominance began to unravel during World War I. The war drained the country's gold reserves and left it drowning in debt. In an effort to restore stability, Britain attempted to bring back the gold standard in 1925, but it didn't last. The Great Depression hit hard, and by 1931, Britain was forced to abandon the gold standard altogether, shaking global confidence in the pound. Meanwhile, across the Atlantic, the United States was on the rise. The creation of the Federal Reserve in 1913 gave the U.S. a strong central banking system, bringing more stability to its economy. Throughout the 1920s and 1930s, New York City grew into a major financial hub, gradually challenging London's dominance. But it wasn't until after World War II that the US dollar truly took center stage. In 1944, global leaders gathered at the Bretton Woods Conference and agreed on a new financial system. With its massive gold reserves and booming economy, the U.S. became the anchor of this system. The dollar was pegged to gold, and other currencies were tied to the dollar, creating a stable global exchange network. This setup made the US dollar the world's primary reserve currency, and for a while it worked. Countries trusted the dollar because they knew it was backed by gold. But by the late 1960s, cracks started to appear. The US was struggling with rising inflation and a growing trade deficit, putting pressure on the dollar's stability. Then, in 1971, something happened that completely changed the way global finance worked. In 1971, President Richard Nixon made a surprise move, one that would change the global financial system forever. Known as the Nixon shock, he cut the link between the US dollar and gold. Before this, countries could exchange their US dollars for gold, but Nixon put an end to that, flipping the script on how money worked worldwide. This bold decision effectively ended the Bretton Woods system, which had been in place since 1944. To understand why this was such a big deal, let's rewind to the end of World War II. In 1944, leaders from 44 Allied nations gathered in the small town of Bretton Woods, New Hampshire. Their goal? To prevent another global economic disaster like the one that followed World War I. The solution was a new, stable monetary system designed to keep currencies steady and encourage global cooperation. Out of this historic meeting came two major financial institutions: the International Monetary Fund, IMF, created to help stabilize currencies and assist countries facing financial trouble; the International Bank for Reconstruction and Development, IBRD. Now part of the World Bank, it was originally designed to help rebuild war-torn Europe and support economic growth worldwide. At the heart of this system was the US dollar, pegged to gold at a fixed rate. Since the US had the world's largest gold reserves and a booming post-war economy, the world trusted its currency. Throughout the 1950s and 60s, countries everywhere stocked up on US dollars, making it the backbone of global finance. But by the late 1960s, cracks began to show. The U.S. was spending more than it was earning, especially with the mounting costs of the Vietnam War. Foreign nations started demanding gold in exchange for their dollars, putting immense pressure on the system. Faced with the possibility of economic collapse, Nixon made his move. His decision to sever the dollar's tie to gold didn't cause the financial meltdown some had feared. Instead, it ushered in a new era of floating exchange rates, where the value of currencies was determined by market forces rather than being fixed to gold. And even without gold backing it, the dollar remained the world's dominant currency. Despite losing its gold backing, the U.S. dollar remained strong. Why? Because the U.S. economy was still one of the largest and most stable in the world. Plus, the dollar was deeply embedded in global trade, especially in the oil market. Thanks to the petrodollar system, countries had to use U.S. dollars to buy oil, reinforcing its position as the world's dominant currency. Fast forward to the 1990s. After the fall of the Soviet Union, the U.S. emerged as the world's only superpower. This was the golden age of the dollar. Globalization was booming, the U.S. tech industry was taking off, and Wall Street was the center of the financial world. Investors around the globe saw U.S. Treasury bonds as the safest bet, and countries kept piling up dollars in their reserves. Even when the euro was introduced in 1999 as a potential competitor, it didn't shake the dollar's dominance. By the early 2000s, nearly 70% of global foreign exchange reserves were held in U.S. dollars. Then came 2008, the global financial crisis. What started as a meltdown in the U.S. housing market quickly spread across the world, shaking trust in American banks and financial institutions. Ironically, even though the crisis originated in the U.S., investors still rushed to the dollar as a safe haven during the storm. But the cracks were now obvious. Central banks around the world realized they had put too many eggs in one basket. After the 2008 financial crisis, many started diversifying their reserves, buying more gold and other currencies to shield themselves from future shocks. Enter China. As its economy skyrocketed, China pushed hard to elevate its currency, the renminbi, RMB, on the global stage. It wasn't just talk. China took action by creating new financial networks, like the Asian Infrastructure Investment Bank, AIIB, to rival Western-led institutions like the World Bank. This gave countries an alternative source for development funding, reducing their reliance on the U.S. dollar. China has been playing a smart game to boost the RMB's global influence. One of its biggest moves? Massive investments in infrastructure through the Belt and Road Initiative, BRI. Think railways in Africa, ports in Europe, and highways in Asia, all funded in many cases using the RMB. This strategy not only ties countries into China's economic network, but also increases the circulation of its currency worldwide. But China didn't stop there. To make international trade easier, without constantly needing U.S. dollars, it set up currency swap agreements with multiple countries. These deals allow nations to trade directly in their own currencies and RMB, cutting the dollar out of the equation. The more these agreements grow, the bigger China's role in global finance becomes. Now, let's talk about something that's shaking up the way money works: blockchain and digital currencies. These technologies are rewriting the rules of how money moves across borders, and central banks around the world are paying attention. To keep up, many have started developing their own central bank digital currencies, CBDCs. By early 2024, over 130 countries, including the U.S., were exploring or actively working on their own digital currencies. But when it comes to digital finance, China is way ahead. Its digital yuan (CNY) isn't just about making payments faster. It's a key part of China's bigger strategy to boost the renminbi RMB on the global stage. Meanwhile, in the world of digital finance, the US dollar still holds its ground, thanks to stablecoins, digital currencies tied to the dollar's value. These are widely used in international trade and online transactions, keeping the dollar relevant even in the crypto era. Still, the dollar's grip on global finance isn't as strong as it once was. By 2022, its share of global reserves slipped to around 58%, while other currencies like the euro, Chinese yuan, and even gold started taking a larger share. A major sign of this shift? The falling demand for US Treasury bonds, especially from China. Back in 2013, China held a massive $1.3 trillion in US government bonds. But by the end of 2024, that number had dropped to about $759 billion. Why the big sell-off? Part of it is that China used to buy tons of US dollars to keep its own currency stable and its exports competitive. But after 2018, as its trade gap with the US narrowed, there was less need to stockpile dollars. On top of that, Chinese officials became increasingly cautious about having too many eggs in the US dollar basket, leading to a steady move away from US debt. Japan also made adjustments to its US debt holdings, carefully managing its treasury investments to stabilize the yen and support its own economic policies. While it remains the largest foreign holder of US debt, Japan has been gradually reducing its exposure, much like China. This trend of countries diversifying away from US Treasuries isn't just about trade tensions, it's about managing risk. The global financial system has long revolved around the US dollar, but as economies grow and new financial systems emerge, central banks are looking for ways to spread their investments. Whether it's boosting gold reserves, investing in other currencies, or developing digital financial networks, the move away from over-reliance on the dollar is gaining momentum. That said, the U.S. debt market remains one of the most stable and liquid in the world, which is why, despite these shifts, demand for treasuries still exists. Even China, despite trimming its holdings, hasn't made any drastic moves, likely because selling off too much, too fast, could end up strengthening the U.S. dollar while making its own exports less competitive. In the grander scheme, this slow shift away from U.S. Treasuries and the dollar isn't an overnight revolution. It's a long-term evolution in global finance. And while the dollar remains dominant, the foundations of the global financial system are beginning to shift in ways that could reshape economic power in the decades to come. Japan has long been the biggest foreign holder of U.S. debt, but its holdings dropped from about $1.17 trillion to $1.06 trillion by December. Even with that decline, Japan still holds the top spot. So why the sell-off? Japan has been working to keep its currency, the yen, from weakening too much against the US dollar. When the yen starts to slide, Japan's central bank steps in, selling US treasuries to buy yen and stabilize its value. On top of that, Japan's domestic policies, like managing interest rates and fighting inflation, also influence how it handles its foreign reserves. Meanwhile, over in the UK, there's been some movement too. After Donald Trump was re-elected in November 2024, the UK reduced its US Treasury holdings from around $767 billion to $723 billion. The reason? A mix of political and market concerns. Trump's plans for big tax cuts and increased government spending had investors worried about rising inflation and higher U.S. government borrowing. That caused Treasury yields to jump, which in turn drove bond prices down, making the UK's holdings less valuable. To cut its losses, the UK decided to sell off some of its U.S. debt. And it's not just the UK, bond markets worldwide felt the pressure. Investors were spooked by the prospect of inflation and rising borrowing costs, leading countries like China and the UK to rethink their strategies. Now, they're focusing more on diversifying their reserves, putting money into assets like gold, and reducing their reliance on US dollar-heavy investments. Another factor? The US dollar strengthened after Trump's re-election, which also influenced these moves in global finance. The shifting value of foreign-held US assets has led countries like the UK to rethink their investment strategies. And over in India, a similar trend is playing out. India has significantly reduced its US Treasury holdings, dropping from $240 billion in March 2024 to just $29 billion. The Reserve Bank of India, RBI, has been fine-tuning its foreign reserves, aiming for more balance and less dependence on U.S. debt. Behind the scenes, the RBI has been working hard to stabilize the Indian rupee as global economic challenges create turbulence. Rising U.S. interest rates and foreign investors pulling money out of India have added pressure on the currency. To keep things steady, the RBI has stepped in to prevent extreme fluctuations in the exchange rate. But India isn't just focused on short-term fixes. It's playing the long game. The country is reshaping its foreign reserves by investing more in gold and diversifying into other assets,